You ever really wonder what the super wealthy are actually doing differently with their money? I mean, we see the results, right? The businesses, the investments, the freedom. But the how can feel like this big, guarded secret, like it's impossibly complex and totally out of reach for the rest of us. Well, the truth is, while the scale is obviously different, the core principle is surprisingly simple. Today, we're going to pull back that curtain and break down a powerful, really straightforward rule for managing your money. And this isn't just some budgeting tip. This is a cornerstone of how the 1% build, maintain, and grow their wealth, generation after generation. It's a fundamental shift in how you think, and we're going to walk through it step by step. Okay, let's dive in. First things first, before we get into any rules or strategies, we have to understand the landscape. I mean, where does wealth actually come from? The numbers on this slide tell a crucial story. Get this, a staggering 75% of the wealthy are entrepreneurs. These are the founders, the business builders, the people who created a system that generates value. Then you've got 15% who are primarily investors, people who may not have started the company, but they use their capital to buy a piece of it, letting their money work for them in the background. About 7% are inheritors, which really is a testament to the power of these principles, right? Wealth was built by a previous generation and successfully passed down. And then you have this tiny 3% who are the absolute elite in their fields, the top tier entertainers and athletes. But just look at that chart for a second. What do you notice is missing? What category has literally 0% representation? The employee. The person who only earns a salary. And listen, that is not a coincidence, and it's definitely not an accident. It points to the one fundamental truth that underpins everything we're about to talk about. And this slide right here gets to the absolute core of it. This is the mindset shift that separates the wealthy from, well, pretty much everyone else. Let's connect it back to what we just saw. Entrepreneurs, they own businesses. Investors, they own assets, stocks, real estate, pieces of other companies. Inheritors own trusts and portfolios that were passed down to them. Heck, even the top athletes and entertainers, in a very real way, own a rare and valuable skill that they've turned into a global brand. See, the common thread here, the one thing that's totally non-negotiable, is ownership. If your only financial tool is a paycheck that you trade your time for, then from a purely financial point of view, you are an asset on someone else's balance sheet. Your labor is building their business, their wealth. So the entire goal of this explainer is to show you how to start shifting from being owned to becoming an owner. Now, before we get into the nuts and bolts of the system that helps you make that shift, just a quick moment for the essentials. Before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Your support really helps us create more deep dives just like this one. All right, let's get back to building your path to ownership. So here's our roadmap for this explainer. We've just covered that foundational concept, the ownership secret. Next, we'll introduce the practical tool to achieve it, the 25-15-15-10 rule. And from there, we're going to do a deep dive into each component, piece by piece. First up is growth, then we'll cover stability, followed by essentials, and finally, rewards. Let's get started. Okay, so let's properly unpack this idea of moving from being owned to becoming an owner. To really get why this is so critical, we have to first dissect the system that most people are unknowingly trapped in. It's this cycle that feels so normal, right? Because pretty much everyone you know is stuck in it. It's the cycle of getting paid, paying bills, and having just enough left over, if you're lucky, to make it to the next paycheck. It is a system designed, whether it's intentional or not, to prevent you from ever truly getting ahead. The source material uses this really powerful, provocative framing, calling it modern-day slavery with the illusion of freedom. Now, that might sound extreme, but just think about it for a second. In the past, a slave worked in exchange for the bare essentials, food and shelter. Today, what do most people do? They work 40, 50, 60 hours a week, they get a paycheck, and where does that money immediately go? To the landlord or the bank for shelter, to the grocery store for food, to the gas station and the car payment for the transportation they need to get back to work. The system is engineered to keep you on a treadmill. It makes you feel rich for maybe a day or two after your paycheck hits, but then broke and anxious by the end of the month. This creates this low-level stress that ensures you never have the mental bandwidth or the financial cushion to step off and think about building something for yourself. And look, understanding this isn't about being cynical, it's about seeing the game for what it is. That's the first, most critical step to breaking free. So if that's the problem, this relentless treadmill, then what's the solution? How do you actually fight back and start carving out a path to ownership? Well, the answer isn't some get-rich-quick scheme. It's not about winning the lottery or earning $1 million overnight. It's about having a clear, simple, and repeatable system for every single dollar that comes into your life. And that system is the 25-15-50-10 rule. This is your practical weapon to dismantle the old cycle and build a new one. So, what is it exactly? Well, the 25-15-50-10 rule is a framework for giving every single dollar you earn after taxes a specific job. Think of yourself as the CEO of your own little economy. This rule provides the 4 key departments for your business: growth, stability, essentials, and rewards. And the crucial point here, the thing I really want you to get, is that this framework has nothing to do with how much money you make. Whether you earn $40,000 a year or $400,000 a year, the principles are identical. Wealth isn't built on income, it's built on discipline and strategy. It's about how you manage what you make. This is the blueprint for building ownership, starting with the very next dollar you earn.
Okay, let's get into the first and, I would argue, the most important part of the rule: growth. This is where you allocate the first 25% of your after-tax income. This money has one purpose and one purpose only: to be put to work for you. This isn't money for your landlord, it's not for your car company, it's not for the grocery store. This is the money that you use to buy assets, things that have the potential to go up in value over time, and eventually put more money back into your pocket. This 25%, this is your ownership fund. It's how you methodically and systematically buy your freedom.
Now, I know what a lot of you are probably thinking. 25%? I don't have enough money for my investments to make any real difference. That thought process is the single biggest barrier that keeps people from starting. They think the amount of money is what matters most. It's not. The single most powerful force in your financial life is time. And to illustrate this, let me introduce you to a classic story, the tale of Billy and Phil. Billy is diligent, but he's not a high earner. At age 20, he starts investing just $200 a month into a simple index fund. His friend Phil is a bit of a late bloomer. He waits a decade, but by age 30, he's earning more money and he wants to catch up. So he invests more, $300 a month every single month. Now, simple logic would suggest that Phil, the one who invests more money, should come out ahead, right? Let's look at the numbers. Let's look at their raw cash contributions first. By the time they both turn 60 and are ready to think about retiring, we can see exactly how much of their own money they put into their accounts. Billy, by investing $200 a month for 40 years, has contributed a total of $96,000 out of his own pocket. Phil, by investing $300 a month for 30 years, has put in a total of $108,000. So let's be crystal clear. Phil invested $12,000 more of his own hard-earned cash into his portfolio. The question on the slide is simple, but it's designed to expose a flaw in how we usually think about money. Who do you think ends up with more? The answer seems obvious, but this is where financial magic, or really financial mathematics, completely shatters our expectations.
And the results are staggering. Just look at those final numbers. Phil does well, he does. He ends up with a very respectable $678,000. But Billy, who invested less of his own money, ends up a millionaire with over $1.2 million. He has nearly double the money of his friend, simply because he gave his investments an extra 10 years to grow. Let that sink in. This is the raw, undeniable power of compound growth. It's your money's earnings starting to have their own earnings. It's like a snowball rolling down a very long hill. That extra decade Billy had wasn't just 10 more years of adding money, it was 10 years where his larger, more established snowball was growing at an exponential rate. Waiting, even if you plan to invest more later, is the single most expensive financial mistake you can make. It can cost you hundreds of thousands, if not millions of dollars. So the next logical question is, okay, where do you put this 25% growth money? It can feel overwhelming. The best way to think about it is like a ladder of risk and complexity. At the very bottom, you have the safest, most foundational assets. For 99% of people, this is where you start: index funds. You're not trying to be a genius stock picker, you're just buying a tiny slice of the entire market, like the S&P 500. It's the simplest, most proven way to build wealth over the long term. The next rung up is real estate, either through buying physical property or through REITs, that's real estate investment trusts, which let you invest in big-time properties without the headache of being a landlord. Now, this middle rung is crucial and so often overlooked: investing in high-income skills. Learning to code, to sell, to market, to become a master of your craft. This is an investment in yourself that pays dividends for life, and no market crash can ever take that away from you. Further up the ladder, you get into higher risk areas like picking individual stocks, and at the very top, alternative investments like crypto, art, collectibles, you name it. The strategy is simple. Start at the bottom, build a rock-solid foundation, and only then should you even think about exploring further up the ladder. Now, having a growth plan is fantastic, but it's incredibly fragile if it's not protected. Think about it. A single gust of wind can knock down the tallest tree if it has no roots. That brings us to the next 15% of your income, which you'll allocate to stability. This is your defense. Too many people make the critical mistake of throwing all their extra money into investments. But then life happens, right? The car breaks down, a surprise medical bill arrives, you lose your job. Suddenly, they're forced to sell their investments at the worst possible time, usually at a loss, and it completely derails their progress. Your stability fund is the moat around your castle. It's the money that keeps you in the game when life inevitably throws you a curveball.
So, how much do you need in this stability fund? The calculation is really straightforward. First, you need to figure out your monthly baseline survival number. And listen, this is not your full budget. This is the absolute bare bones minimum you need to survive. It includes only the essentials: your rent or mortgage, groceries, utilities, essential transportation. No restaurants, no subscriptions, no entertainment. So let's say for this example, that number is $1,500 per month. The goal, according to the source, is to save 5 months worth of that baseline. So in this example, your stability fund target is $7,500. Until you hit that number, 15% of every single paycheck goes directly toward this fund. Once it's full, you can then redirect that 15% over into your growth category to really accelerate your investments. Now, where you keep this stability money is just as important as having it in the first place. This money has a very specific job, and it needs to be in a very specific type of account. There are 3 non-negotiable rules. 1, it has to be liquid. That means you need to be able to get your hands on it within 24 hours, no questions asked. This is not the time for complicated withdrawal processes. 2, it must be zero risk. I cannot stress this enough. Do not, under any circumstances, invest your emergency fund in the stock market or anything else that can lose value. This money is your insurance policy, not a growth asset. Its only job is to be there, stable and reliable when you need it most. And 3, it must earn interest. Don't let it just sit in a checking account getting eaten alive by inflation. Put it in a high-yield savings account where it can at least earn some interest and maintain its buying power while it's waiting to protect you.
We're at about the halfway point here, and we've covered the offensive side of your financial plan, growth and stability. It's a lot to take in, so this is a great place to pause for just a moment. And as a quick reminder, if you're finding this breakdown valuable, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Okay, let's transition to the other half of the equation, managing your day-to-day spending. All right, now we come to the biggest slice of the pie, the 50% allocated for essentials. This is the money that keeps your life running. It covers your housing, your food, your transportation, your utilities, all of your genuine needs. But the real key to this category is in the subtitle, the money that feeds you, not your ego. You know, this is the area where most financial plans just completely fall apart. It's where a silent wealth killer called lifestyle creep lives. And that's the thing where, as your income increases, your spending just magically rises to meet it, leaving you in the exact same financial position as before, just with nicer stuff. This quote perfectly captures the mindset you have to control that 50%. Our society has such a warped definition of wealth. We think it's the person with the fancy car, the designer watch, the huge house. But that's not wealth. That's just spending. It's an illusion. I guarantee you there are people out there earning 6, even 7 figures who are absolutely drowning in debt and living paycheck to paycheck because they are constantly trying to look rich instead of actually being rich. True wealth is what you don't see. It's the fully funded investment account quietly compounding in the background. It's the paid-off mortgage. It's the financial freedom you're building by not buying the expensive car or the designer clothes. It's the assets you own, not the liabilities you show off. Keeping your essentials at or below 50% is a conscious choice to build unseen wealth over visible status. So how do you actually control this? How do you fight back against that constant pressure to upgrade your lifestyle? Well, you don't rely on willpower, you use a system. Here's a simple 3-question framework to run every single non-essential purchase through. When you're tempted to buy something, first ask yourself, is this an impulse? Be honest with yourself here. Did you just see it and decide you want it? If the answer is yes, apply the 7-day rule. Just wait a week. I promise you, 90% of the time, that urge will completely disappear. If you still want it after 7 days, then move to question 2. Am I buying this for the brand or for the value? Are you paying a premium for a logo, for marketing, for status? Or are you paying for genuine quality, utility, and durability? Always chase value, not logos. Finally, if you're confident you're buying for value, ask the last and most important question. Will this purchase genuinely and materially improve my life? If the answer is a clear, intentional yes, then go for it. This system isn't about depriving yourself, it's about being intentional. is short circuits emotional spending and make sure your money goes toward things that truly matter. All right, we've covered offense, defense, and keeping your core expenses in check. So let's talk about the final 10%, dedicated to rewards. Now, this might sound completely counterintuitive, right? After all this talk of discipline and saving, why are we setting aside money specifically to spend? This is a crucial point. This category is not an excuse to be frivolous. It's a strategy for sustainability. A financial plan that has no room for joy is like a diet with no flavor. It's rigid, miserable, and ultimately it's destined to fail. You'll just burn out. This 10% is the pressure release valve. It's the money that keeps you sane and motivated for what is a long, marathon journey of building wealth. The key here is to spend this reward money effectively. This isn't for buying random stuff on Amazon that'll give you a fleeting dopamine hit. This is for intentional, high-value, guilt-free spending that genuinely enriches your life. Things like vacations, where you're not just buying a trip, you're buying memories that will last a lifetime. Hobbies that keep you passionate and engaged and interesting outside of your work. Experiences with friends and family that strengthen your social connections, which are a huge part of a happy life. And using the money for gifts for loved ones, which are really just investments in your most important relationships. When you spend your reward money this way, it stops being an expense and starts being an investment in a rich life, not just a rich bank account. So let's bring it all together and just recap the entire framework. It's a simple but a profoundly effective blueprint for your financial life. The first 25% of your after-tax income goes straight to growth, buying assets that work for you and build your ownership stake in the world. The next 15% goes to building your stability fund, your financial defense that protects your investments and your peace of mind. A hard cap of 50% is for your essentials, covering your needs while consciously resisting that urge to feed your ego with lifestyle creep. And that final 10% is for rewards, strategic, guilt-free spending on experiences that make the entire journey sustainable and enjoyable. That is the 25-15-50-10 rule. And that brings us to the end of this breakdown. I really hope walking through this framework has given you a clear, actionable plan to take control of your financial future. Thank you so much for watching. Don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. I want to leave you with this one final thought, a question to really reflect on. Your money is neutral. It's just a tool, like a hammer. But every single day, with every dollar you earn, save, or spend, you are making a choice. You are picking up that tool. And with it, you are either building the walls of a financial prison, a life of debt, stress, and being owned by your circumstances, or you are using it to pave a path, brick by brick, to true freedom. The freedom to choose your work, your time, your life. The plan is in front of you. The choice is yours.